Okay, Tyler, you and I did a video a couple of weeks back talking about Albemarle, and the headline was something along the lines of this deal could make a screaming buy. And as the universe works sometimes, that deal came apart. It fell apart and stock's down about 18% since then. So I think we owe the viewers out there a revisit of Albemarle, its current situation, because some other stuff has happened along the way too. Time for us to take another look and decide, should investors avoid Albemarle, or maybe is it still a buy?
Can't get them all right, buddy. So let's try to work through what happened here.
Yeah, before we do that, though, just a reminder, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, please go to our special link, fool.com/thesmattering. And The Motley Fool is going to give you its 10 best stocks to buy right now. Please check out that link after this video. So Tyler, a couple things I think are really important. First of all, the demand for lithium is still massive, right? And that's what underpins the whole thesis. The acquisition, the Liontown acquisition that fell through that we're going to talk about, that was one of the catalysts that would help Albemarle by acquiring those assets. But again, let's lay the case, first of all, for the thesis of Albemarle as a buy. And then we'll talk about everything that's happened since then and reach a conclusion about where the business is right now.
So long-term demand, obviously we're talking about the electrification of everything. Lithium demand is pretty much predicated on lithium ion batteries. Now, the primary driver for that, of course, is electric vehicles, right? That's the biggest, if you look at any any projection chart that's forecasting growth in lithium demand, the vast majority of it is in electric vehicles, right?
Which makes sense if you think about on a global basis, so much of the energy goes into transportation. So it makes sense.
Right. And the things that we can displace the most in terms of energy demand and electric vehicles
right,
is going to be the one that's going to do it.
Yeah.
So according to Albemarle, at least in their management presentations, they're expecting between about now and 2027, even out to 2030, they're expecting lithium demand to increase annually. It's somewhere between 25 and 30%, which, as we've mentioned before, in mining and commodities, those are absurd levels of growth. There's no other way around the idea that trying to grow lithium, any type of mining or commodity production by 25% annually is spectacularly hard, even for the entire industry to do it. And Albemarle was trying to do its best to, rise to the occasion in their presentations. This was prior to this Liontown deal falling through. What they had been projecting with this deal was that they were going to almost triple their production of lithium carbonate equivalents, a standardized way of saying this is our lithium production. So in 2022, they did about 200 tons per year of lithium equivalent. And then in 2027, they were expecting somewhere between 500 and 600. So close to or at a tripling of total production in a matter of 5 years, which, again, spectacular growth, a lot of things that we don't see. However, part of that projection was based on this Liontown Resources deal. Liontown Resources was a lithium miner in Australia. They have what's called lithium carbonate rock. It's been one of the ways that Australia has been a bit major player in this. When we typically think lithium, it's been these solar brine fields in South America, in the Chile, Bolivia, Argentina, kind of that where all those three of those countries come together. Lithium carbonate rock, which is actually just typical mining, that they found deposits of that we've been able to actually make into.
It's a high enough concentration where it's economic to produce.
Look, we found some in Nevada that they're trying to develop by other companies, and then Australia has a very large proportion of this particular commodity. Liontown had a lot of acreage and some mineral rights that would have allowed Albemarle to use that effectively and also leverage its existing supply chains and production, because they also have a lot of upgrading facilities in Australia, in China, places that are the ones that are refining the stuff today. So it was a good strategic fit.
Without getting into the details too much, some things happened with Liontown that kind of undermined it. I think there was an activist investor that jumped in and made some substantial investments that was agitating to increase the value of the deal. And the short version is the management, Kim Masters, CEO of Albemarle, said, okay, we're done. And they walked away and they moved on. What happened after that? They lost that deal, and then very quickly they did something pretty important.
So on October 15th is when they said, look, we're done with this deal. It's getting way too complex. This activist shareholder stuff's getting too much for us. It's like a bad episode of Succession that we're like, we're not going to deal with this anymore. And so 3 days later, they took one of their joint venture deals with another Australian company called Marble Resources and basically acquired some of the assets within that. They acquired one of the upgrading facilities in China. They had higher economic interest in some of the mines.
350 to 400 million is the estimated price.
Thank you.
Yep.
We have this, it was almost like a consolation prize. Like we couldn't land the Liontown deal, so we need to move pretty quickly. And that was the deal that they just happened to strike because they were banking a lot on this growth story, and absent the Liontown deal, they needed to find something else. And if that wasn't enough,
12 days later,
12 days later, we got an announcement that says we have a new CFO. It basically said the new CFO is Neil Shiori. I hope I'm saying that. He came from Dow Chemical Company. Yeah, I'm not going to go any further than that. But basically, there was no like predetermined announcement that the CFO was retiring or there was going to be this long transition. It was like, nope, our existing CFO's moving out. This new guy's coming in effective November 6th. And the CFO is going to transition to a strategic advisor to the CEO. What that means, we don't really know. It's very interesting to see those three things just happen in succession, right? We had a pull out of a deal, quickly re-sign, re-engineer, restructure a joint venture deal, and then the CFO gone, all within 2 weeks. That's a lot.
Tyler, management's hung their hat on some really aggressive, big growth goals. And the concern that I would have is now, are they starting to move to a position where they're going to start overpaying for assets to achieve those growth goals versus taking the best capital allocation steps for the company, which Albemarle has been really good at in the past? How concerned are you? And if you are concerned, what are you most concerned about right now?
Taking deals in a joint venture, like they know what those were, so maybe they were able to price it better. I would be concerned if they start running around trying to ink a whole bunch of new deals right now. I think that would be kind of a sign that they're desperate and trying to perhaps play catch up and really throttle on that growth story again, when I don't even know if they have to really. Like, again, for at least from an investor perspective, I want to speak more to my style. I would much rather see high returns on measured growth than huge 25, 30, 40% growth from a mining company at marginal returns on capital, maybe even just barely beating your cost of capital. For me personally, this hasn't necessarily been a problem for Albemarle, but considering this weird transition that they've had, and it looks like very fast moves that seem a little incoherent, I do want to see what happens next. This is one of those, whoa, I don't know if I want to be jumping into this thing full 2 feet at the same time, even though its stock has gone down considerably, and people might look at it and say, hey, look, the forward PE estimate is less than 8. That's a great deal, right? We don't know because we just hit a really weird speed bump.
I think that's a fair way to think about it. And as is typical of our conversations, you tend to take the more conservative approach with allocation. I still say this is a good time. There can be times, I think, with these miners and these very cyclical stocks, there can be times when the market gives you an obvious opportunity to take a sizable bet. The stock is very beaten down. The market on that particular good, in this case, lithium, is really low. And we know eventually it's going to recover. And this is a strong business. And it's a time to buy a bunch. I don't think this is one of those cases because of that uncertainty. But again, thinking about the history of performance of the business, I think it's still a reasonable time maybe to start building a position out. Maybe open a small position, maybe add a little bit, but definitely not a time, I think I agree with you, to take a sizable position because there are those unknowns that could completely undermine the economic performance of the business. Take a small position, follow it, see what they start doing, like you said, with further allocation decisions. And then if they start taking missteps, yeah, then it's going to be time to walk away.